Today's lesson, we're going to be focusing our attention on what we call life annuities. Now, the word life is very important because basically what it essentially means is that you're going to have a lifelong income. In other words, you will not outlive this particular plan. Now, it will pay you as the annuitant for the rest of your life. So you may want to look at a life annuity really is like permanent insurance, and that permanent insurance covers you for the rest of your life. And a life annuity basically gives you a payment for the rest of your life. Now, there's various different kinds of life annuities, basically. In other words, we actually have about 5 different main kinds. There's variations of all of these things here, but there's basically 5 different kinds of annuities. And so when you look at the fact that the key word here is lifelong, it really pertains to you as the annuitant, not to your beneficiaries or anything along that line. It's really to you. So as long as you are alive, you will in fact get that particular income. So if we guaranteed you $5,000 a month for the rest of your life, that's exactly what it means. That said, however, you also have to take a look at the various different kinds of life annuities. The first one is what we call a straight life annuity. This is the one that actually gives you as the annuitant the maximum amount of money for the money that you've actually deposited with the insurance company. So, but it only covers you. In other words, if you died, any time when you die, there is no more payments. In other words, it's straightforward. It's up to you. It's only for you, and that's it. There is no actual beneficiary. So it does give you the maximum amount of money. So, for example, if you don't have anybody to leave your money to, you don't want to leave it to a charity, you don't want to leave it to a named beneficiary or anything, you're simply saying, I want to have the maximum amount of money I can possibly have while I'm alive, then obviously for you a straight life annuity is really what you need. Okay. The second kind of annuity is basically an annuity. Again, remember, it's always a life annuity for you. However, if in the event you bought a cash refund kind of annuity, then what will happen is at the moment that you actually pass away, if there's any amounts of money of your principal that still has not been used up at that point, it will be refunded to your beneficiary. So if, for example, you gave us $500,000, but you only actually ate away at $400,000 or so, it's $100,000 is still left, the beneficiary will, of course, will receive a lump sum of that $100,000, and that'll be the end of it. Because again, the life annuity is only for you; it's not for your beneficiary. So therefore, there could be a lump sum payment at the other end. If there is any money left over, it will be paid out. There's also a number of different guaranteed payments available as well. These guaranteed payments, you might want to also look at them as installment payments, you might say. So, for example, if you've got a 5-year guaranteed payment or 5-year installment payment, if you died any time within that 5 years, so you died in the 3rd year, your beneficiary will in fact receive an income for the next 2 years. Remember, again, you as the annuitant, you'll get an income for the rest of your life. All we're really saying is that if you died within that guaranteed period, so you had a 5-year guaranteed period, you died in the 3rd year, your beneficiary will in fact receive the same amount of money that you were receiving for the balance of that 5 years. So in our example, 2 years. There's also a 10-year guarantee, for example. So once again, if you died any time within that 10 years, what will happen is that, let's say you died in the 5th year. For 5 years, your beneficiary will receive the exact same amount of money as if you were still alive, and then it terminates. Once again, as long as you live, you're going to get it. But if you have a 10-year guarantee, if you die within that 10-year, say you died in the 5th year, your beneficiary will receive that same amount of money for the balance of that 10 years, and then, of course, it will drop off. And the third kind of installment plan basically is 20-year guarantee. So same situation. You've got a guarantee period of 20 years. You die in the 5th year. Then your beneficiary for the next 15 years will receive the exact same amount of money as if you were still alive, basically, and then it terminates. Okay, so you have to look at the various different guarantees and everything, various different installment payments that are actually made. The last kind is what we call a joint last survivor. This is usually between 2 spouses, and essentially what happens is that a payment is made out to the spouses, let's say $5,000 a month. When one of them dies, the remaining spouse, the spouses that's alive, in other words, the survivor, okay, will continue to get that $5,000, or perhaps a little bit less, depending on how we structure the annuity. But basically, what we're saying is that in all of these cases here, there's really only one life. This was a single life annuity, basically. In a joint loss survivor, it's really two lives. And like I say, usually husband and wife type of situation. One of the spouses ends up passing away. The surviving spouse will continue to get an income for the rest of his or her life as well. And it could be exact same amount of money as they were getting before. That's the way they structured it. Or they could have structured it that they got more money when both of them were alive. And then when one of them died, the amount of money actually reduced, let's say to 60% or something, whatever. And that way, the surviving spouse will continue to get that income basically for the rest of his or her life. So these are single life and the joint life spousal annuity, basically.